You won't be surprised to hear that news flow is about to go pretty quiet as we head into the Christmas holiday. Things don't really pick up again until the retailers start issuing seasonal trading statements on the 5th of January, when Next, Superdry and Grocer Morrisons will be first out of the traps. As a result, we're going to run two different pieces over the festive period, one which looks back at 2020, if you can bear it, and one that looks forward to 2021 and beyond, and the key trends that might just shape portfolio performance going forward. This time we're going to look back on 2020 from the very narrow perspective of financial markets with the help of 5 graphics, so we can look at the themes which dominated, as they could still have a say in 2021. So, first up, we're going to look at which asset classes did best in very broad terms in 2020. Hard to believe as it may be, given the pandemic, March's market chaos and subsequent recessions across many countries, developed or emerging, equities were the best place to be in 2020. As benchmarked by the MSCI All World Index, global stocks beat corporate bonds, government bonds and high-yield or junk bonds, with commodities dead last. Now I know there are other asset class options in there. I did say this was just a broad top-down look. Equities benefited from government, fiscal and central banks' monetary policy support schemes and hopes that vaccines would prompt a strong economic recovery in 2021. Bonds did well as a haven in the first half, when commodities, especially oil, were crushed owing to the recession. However, one trend that you will see from 2020 is that it was, to use a sporting cliche, a game of two halves. So in these graphics, I'm not only showing the full year performance data, but the figures for the second half only. Now, in the second half of this year, equities still came out on top, but commodities shot up to second and high yield came in third. That suggests investors were moving away from fears over the pandemic and recession and toward pricing in a recovery, thanks to vaccines, fiscal and monetary stimulus and central bank promises, notably from the US Federal Reserve, that it would let inflation run hot, certainly at least if it got the chance. Now, this game of two halves can also be seen in our second graphic, which looks at the 8 major geographical options available to stock market investors. I suspect a lot of you would put your money on America being the best performer in 2020, and so it was for much of the year. But in the end, Japan and Asia both overtook it. The UK was a turgid performer, weighed down by its sector mix and heavy exposure to banks and oils and limited exposure to tech. It was also weighed down perhaps by Brexit uncertainty and perceptions, fair or unfair, that the pandemic hadn't been handled that well. In fact, the UK was the worst performer for the second half of the year, when Latin America, the Middle East, Africa and Asia were the best. Now, the switch toward emerging markets again hints at investors looking for cyclical growth, value for want of a better turn of phrase, rather than secular growth or more reliable trend, almost defensive progress, as well as also a search for global export and inflation plays. This can be seen in trends in global equity sectors too, our third graphic, as benchmarked by the S&P Global 1200 indices. It's no shock to see technology romp home as the top sector of the year, and financials and energy emerge as the biggest losers. So many tech stocks were seen as pandemic winners, helping companies or individuals cope with lockdowns, recession, the effects of the virus, and also as a supplier of earnings growth even at a time of great economic difficulty. Tech did well as a result in the second half as well, but by then it wasn't the only game in town. Materials, that's mining, industrials, consumer discretionary and financials all outperformed tech after June, raising issues of valuation and fears of regulation within tech, and also again flagging that possible switch in investors' affections from secular to cyclical growth. The issue is, will this last or not? Now, you can see this switch from expensive defensives to cyclicals, from growth to value, from havens to recovery plays, also by looking at performance trends within the FTSE 100, our fourth graphic. The best performing stocks in the year to date include Scottish Mortgage, the investment trust whose portfolio is packed with potential long-term growth winners, as well as silver and gold miners Fresnillo and Polymetal, and lockdown beneficiary and gambling services provider Flutter, also potentially seen as a long-term winner thanks to betting deregulation in America. The losers, well, they were the banks, hammered by recession, dividend payment bans and a flat yield curve. Oils, hit by recession, a plunge in demand and public pressure for a move away from hydrocarbons. And travel-related players like IAG and Rolls-Royce. But in the second half, recovery players came into their own. Commodities player Evraz, Hotelier, Whitbread, Miner, Glencore, Engineer Melrose. While steady eddies like National Grid, Reckitt Benckiser, Pennon, DCC, and even the big pharma players AstraZeneca and GlaxoSmithKline began to flag. Again, this seems to be the market looking to price in a recovery, and perhaps inflation, in 2021, although we must all remember that markets like to climb a wall of worry but can sometimes slide down the slope of hope if things then don't go according to plan. And that topic of inflation is where the fifth and final graphic comes into play. It shows where the markets think inflation will be in America in 5 years' time. At the time of recording, that's 1.92%, almost bang on the Fed's 2% target, so bully for them. But that figure has surged, that expectation has surged from its pandemic lows of March. So markets are wondering again whether the combination of dollops of fiscal and monetary stimulus will lead to inflation, especially when coupled with perhaps more regional rather than global supply chains, and also supply-side destruction as companies go broke or cut back on investment. Now, this is by no means certain. The pandemic could lead to huge government and corporate debt piles and demand destruction, thanks to corporate failures and rising unemployment, as well as possible changes to how we live on a longer-term basis, especially if working from home becomes a widespread, more permanent trend. No one knows which will prevail, inflation, deflation, or the worst of all worlds, stagflation, but the range of outcomes requires a range of asset allocation strategies, at least if history's any guide. But then, if all we needed was history, the librarians would be the best investors, as Warren Buffett once put it. Some of you may take the view that central bank money printing and government deficit creation will lead to a melt-up in markets whatever happens. Some may fear markets are too exuberant, frothy, complacent, and therefore worry that a stumble is coming. One thing is for certain, investors have much to ponder as they prepare for the year ahead. I hope that you and your families are all in good health and good spirits, especially at this time of year, which I know is special to many of you. Keep well, and I look forward to talking to you again very soon.